Hello everyone, welcome back. Hope all of you are doing great. So now we will learn a new chapter, which is chapter 18, and that's the last chapter of this course and from your textbook, and it's really exciting. In this chapter you will learn about the accounting methods for not-for-profit organizations, and we basically will focus on private not-for-profit entities, and you will understand like there are different type of financial statements, and you will understand the differences in their assets. You will see some assets they keep as restricted, some are unrestricted. You will also understand different type of contributions, how do they record it, and a little bit of tax exemption status, merger and acquisition, and of course we will focus at the end one specific type of not-for-profit entities, that is healthcare entities. So not-for-profit organizations are of course different than for-profit organizations. One main criteria is that they receive significant amount of donation and contribution. They can receive their contribution from different providers, but those providers actually don't expect any return, which is completely different than a for-profit organization. For example, for a for-profit organizations, usually investors, shareholders, or a creditor could provide fund, but they could expect a return from their investment, from their contribution. But for a not-for-profit entities, whomever is contributing, whomever is donating, they actually don't expect that return. And every not-for-profit entity should have an operating mission. It's not only to provide goods and service, they should have something else, some operating mission. Most of the cases, it could come from some ethical or moral point of views. And they also do not have any ownership interest like that for-profit business. That means whoever is contributing, they cannot claim that they are the owner. They cannot dictate the company like as an owner. So some of the non-profit entities that can be classified as governmental entities, for example, a state-operated hospital or a public university. But here we mainly will focus on private not-for-profit entities. For example, any charitable organization, college, universities, civic organization, or trade organization. So you will see here one chart from our textbook. So these are the different types of not-for-profit entities, those who receives contributions, huge amount of contribution, and you see billions of dollars. Religion is a very big sector, education, human service, health, public society benefits, even art, culture, humanities, environment, animals. So they are the very common types of not-for-profit entities, and these recipients of these billion dollars of contribution. Now, who are actually providing those contributions? Anyone can contribute, for example, in individuals, or even for any corporations, they can contribute. So again, you see here, it's a little bit old information, but it says that from 10 to 2011, actually this charitable amount actually increased by 4%. And here you will also see US 10 largest charity organizations, and YMCA is here in terms of their revenue. It's the largest one, and they have different sources. Some not-for-profit entity can receive like service revenues or some support from the government or public support. So these are the largest top 4 largest charities. Well, it's a little bit old, but still you will see more or less these are the largest charities. So you see here that not-for-profit entities actually deal with billions, millions of dollars. So they are dealing with so much money, and that's why they need to be fair when they're gonna present their financial statements. Although the fund or contribution providers don't claim any return, they don't claim themselves as the owners of the not-for-profit entities, still not-for-profit entities must need to present all of their financial information in a fairly manner, so that their current and potential contribution understand that how financially stable these entities are and how well they actually use all those donations. So to convince the donors, not-for-profit entities must need to prepare some financial statements. And here you need to remember one thing, that there are two types of not-for-profit entities. One is governmental, another is private. So governmental not-for-profit organizations actually follow GASB standards. You know that you learned in last two chapters, GASB, that means Governmental Accounting Standard both, but our focus in this chapter is mainly on private not-for-profit entities, and FASB actually sets the accounting standards for those private not-for-profit entities. So when FASB sets those standards, they have several goals. One important goal is that financial statements should be focused on the entity as a whole. That means their financial statements should not be kind of structured or should not highlight only some individual funds. Rather, they need to present the financial position of the entire organization. And another criteria is that the reporting requirements for private not-for-profit entities should be similar to those applied by for-profit businesses, unless critical differences exist in the nature of the transactions or other informational needs of financial statement users. So these are two common criteria that FASB actually focus on, and you see here the first goal, as I mentioned, that the financial statement should not highlight individual funds. Rather, FASB emphasized that the operation and the financial position should represent the condition of the entire organizations. And the second goal, as I mentioned in my earlier slides, is also allows the use of many of the same accounting techniques utilized by for-profit entities. So you will see most of the journal entries and several accounting methods and standards are pretty much same like the for-profit business, and especially you will see the capital leases, pension, contingent liabilities, and those have not been rewritten. They actually follow just like the standards that are followed by for-profit entities. These are some examples of FASB standards. For example, FASB Statement 116, accounting for contributions received and contributions made, that actually established the guidelines for determining when and how donations should be recognized and reported. On the other hand, another FASB statement is FAS 117. It actually specified the required content and format for financial statements distributed by these organizations. So you will see there are kind of distinct difference between the private not-for-profit and for-profit business, although both standards are developed by FASB, and most of the cases you will see that the basic concept is similar accounting concept, but there are some differences. For example, donations received by private not-for-profit entities are transactions that have no counterpart in commercial business. Another difference is that the private entities donations often have donor imposed restrictions, and we'll see different type of assets like restricted, unrestricted, temporarily restricted, and there is no like single figure that actually describes the efficiency or the performance of any not-for-profit organizations. For-profit organizations, we know like net income number. Net income number tells how efficient the company is going, but you really cannot say the performance based on only one figure. So you see there are still subtle differences, and that's why there is a need for a unique set of financial statements for not-for-profit entities. And we'll go over some examples from the textbook. I'll show you my e-textbook to go over some examples. So FASB actually requires three financial statements. It's actually like the for-profit businesses. So one is their statement of financial position, and this statement of financial position is pretty much like a balance sheet, because we'll see that reports their assets, liabilities, and net assets. So net assets is a kind of owner's equity. For-profit business, we show the owner's equity portion, right? On your balance sheet, you show all assets on one side, and then liabilities, and then owner's equity. But the difference between their assets and liabilities, they actually call net assets. Now they also have another statement that they need to prepare, which is called statement of activities. And the statement of activities is just like an income statement where they record all of their revenues and expenses, as well as if they need to do any changes in their net assets for that period. Now the third item is just like the statement of cash flows, and they also classify all of their activities into three categories: operating activities, investing activities, and financing activities. And they can also follow either direct or indirect method. But in addition to these three financial statements, for health and welfare organizations, they need to prepare another set of statements, which is called statement of functional expense. It is especially required by the health and welfare entities, and we'll see some examples at the end. Okay, now I'm showing you my book, and I hope all of you have your textbook. So we are actually checking one example from your textbook, and this example is from page number 819, and this is the example for one not-for-profit entities, Child Fund International USA, and you see their consolidated statement of financial position. As I just mentioned, that the consolidated statement of financial position is just like the balance sheet, and you see here they have their all of their assets, what we do for a for-profit business, and then they have their liabilities, but instead of their owner's equity section, they have a net asset sections. And here you will see that net asset section is really crucial because they actually classify these net asset sections into three parts. One is called that unrestricted, another is called the temporarily restricted, and another is called permanently restricted. So when actually donors can make those donations, they can impose some specific requirement, and those requirements could be held for certain period of times or could be based on certain activities, and those based on those restrictions, they actually classify those. So this unrestricted part is basically that includes like broad board designated or like kind of internally restricted assets, and temporarily restricted is basically imposed by their outsiders or external donors, and that is temporarily restricted. That means that is kind of held for restriction for a certain future period of time. On the other hand, for these permanently restricted, these net assets are those assets that are expected to remain restricted for as long as the organization exists. So basically they usually don't transfer anything from these permanently restricted funds. Now we will see here statement of activities. So statement of activities is just like an income statement where they show all sorts of their revenues and expenses, but one specific criteria is that they actually show the changes in these net assets. Remember, these net assets is just like net equity, and what we do for a for-profit organizations, we report all of our revenues and expense, and the difference we call net income, and we show that net income on our statement of retained earnings, and a part we may give as a dividend, and then that is actually reflected here under our stockholders equity part. I'm talking about a for-profit business, and we have some other items like paid in capital and of course that retained earnings. So basically that part reflects the difference between revenues and expenses. So in addition to their regular revenues and expenses, they also show how these three categories of net assets actually change during that year. So I can show you one example, and it's from your textbook, page number 822, and then you will see here that these statement of activities actually prepare separate columns for all those three restricted funds. So now here you can see this example from your textbook. It's their statement of activities. So they are actually preparing separate columns, and they are identifying all those items, how those three categories of their assets, net assets, are changing during this year: unrestricted, temporarily restricted, and of course you will see for permanently restricted, usually it will not change because those funds are kind of kept as long as the organization will exist. And then you will see they also have these changes for all these three categories, and they also record regular revenues and regular expenses. So this is their statement of activities. And unlike for-profit corporations or for-profit entities, they don't show one specific number that will reflect their performance, like the net income number. So here, one thing you need to remember, that when any temporary restrictions is fulfilled, say for example that temporary restriction could be assigned by some external parties, and it could be for certain particular purpose or for a certain future time period, and if it is fulfilled, then those amount is kind of reclassified and unrestricted, and you have to remove it from that temporary restriction to unrestriction. And if an expense is incurred to meet a donor stipulation, both the expenses and the contribution appear in the statement of activities, and it must need to be reported in the unrestricted column and in the same period. Now we will see that how their statement of activities reports different type of expenses, and those you will see two basic categories. One, they call it program service, and another they call it supporting service. So basically these program service expenses, these are actually kind of activities relating to their basic goal and social service research, and these are, you can say, like those are closely related to those not-for-profit entities' mission. On the other hand, for supporting services, those actually cover some administrative cost, management, and general cost. It could be even for fundraising expenses. Now, just like a for-profit business, any not-for-profit entity can also need to produce a statement of cash flow, and they actually classify their all cash activities into three categories: and operating, investing, and financing, and they can use their either direct or indirect method. So you just have seen the three basic financial statements for our not-for-profit entities. These are statement of financial position, which is just like balance sheet. Another is statement of activities, like an income statement, and statement of cash flow. Now, in addition to these three statements, as I mentioned earlier, healthcare and welfare entities, they are required to prepare another statement, which is a statement of functional expenses. Now you will see one example from your textbook, page number 824. This is that Child Fund International's example, and it shows their consolidated statement of functional expense. It's a little bit tiny. I hope all of you have your textbook and you will go over that. So because they actually deal with billions amounts of contributions. So basically contributors may be concerned with how their donation and contributions are used. So this statement actually provides a detailed analysis of expenses, both based on their function and objective. As I mentioned that here for their expense category, they actually classify those into two parts. One is their program service, another is supporting service. So program service expenses are basically related to its mission. So in this example, you will see that they have actually 6 categories. So up to these are the 6 categories: program service related costs, basic education, health and sanitation, nutrition, early childhood development, micro enterprise, and then they have another emergencies. So these are the 6 basic mission related categories, and those are under program services, and again they show one total column. And for supporting service, which is mainly fundraising cost and their management administrative expense, they have these two columns, and this is their total supporting service column. And if you add this total program service and total supporting service, and then you will find their total expense, and this is how you will be able to know the very detailed analysis of their expenses. Now let's take a look at accounting for contributions. Contributions are of course really very significant and important because that provide a major source of support for many of private not-for-profit institutions, and contributions could be unrestricted transfer of cash, or it could be any other resource. And it also, donors can sometimes put restrictions on their contribution, and they can specify how the amount will be used. So there could be like different categories. So we will see one examples from your textbook. So if you have textbook, please you can open page number 825, and it says that $1,000 pledge to be paid in 8 months, and that is restricted for the purchase of library books, and that is recorded immediately because it is not conditional. Since there is no since it is not conditional, so you have to record it, and you are not receiving those $1,000 right now. So right now you will record it as a receivable, and they call it contribution receivables, since you're gonna receive it in 8 months. And this is a receivable. If you receive very soon, like in 8 months or even in a year, you can record the total amount. But if you receive in like in 3 years or 5 years, then you need to calculate the present value of these future receivable amounts when you're gonna do the journal entry. And there is one restriction, because when the donors made that donation, they say that it is restricted for the purchase of the library books. So you can call it a temporarily restricted net assets, because once they will purchase, that the restriction will be fulfilled. Now we will see another example. So cash is not the only type of support that a not-for-profit organization will receive. Many organizations can receive other like materials or any type of things. It could be any vehicles, office furniture, or computers, or foods, or clothing, toys. Even anyone can donate any marketable securities. Now how you gonna record it? So we will see another example, and here this illustration says that local voluntary health and welfare organizations, they actually receive these following items: bed, tables, clothings, and these are the fair value. Remember, when you're gonna record it, you have to record as per the fair value. And in addition to this, they also receive some marketable securities, and the fair value is $32,000. And we assume that the charity distributed the furniture and clothing almost immediately. So now what should be the journal entry? Let's check the journal entry. First, you have to record all those inventories, furnitures, clothes that they received, and you're gonna record it as per the fair value as of the date of those received. So you will record inventory of donated materials. It's just like inventory is increasing, you debit it. And then, since there is no restriction so far when you went over the illustration, so you will show it in your unrestricted net assets column. So this is the journal entry to record all those materials, donated materials. Now, it also mentions that the organization actually distributed all those furnitures and clothing immediately. So now you have to show those an expense. So they call it community service expense, and they all distributed, or they all expense all those furnitures and clothing, and they also need to reduce their inventory, and they will reduce all these values. Now for the marketable securities, they will debit investment in marketable securities because someone is transferring their security, and they will credit permanently, they will credit as permanently restricted net assets. So this is how you gonna calculate all those numbers and you can record all those journal entries. Now let's see the accounting for contribution. So there could be different type of contribution, and first we're gonna focus on any art or historical treasures. And FASB actually says that you don't need to recognize, but you need to disclose this type of information. Actually, this is really very interesting. In 1990, FASB actually issued an exposure draft, and they proposed that all not-for-profit entities must need to record all contributions, and including all works of art and museum pieces, and they need to record all those as assets. Then what happened? FASB receives thousands of letters from different not-for-profit entities, and they all were opposing to that exposure draft because they say that basically those type of art or museum pieces that actually not directly increase their cash flow, rather they actually pay a lot for maintenance or for security purposes, so they argue that those should not be recognized as assets. And later FASB actually issued in 1993, and they issued another note that they said that they don't need any formal recognitions, but they must need to disclose of these type of receipts. Now any type of exchanges such as member fees, dues, those you have to record as revenues. Now sometimes you will see that some contributor service, you will see that hundreds of volunteers can work for any not-for-profit entities, and those also have some values. So not-for-profit entities must need to recognize those, but there are certain criteria. If you see these type of voluntary services and that may meet any of these criteria, then you have to recognize as a revenue. Number one criteria is that the service creates or enhances non-financial assets. So if these type of services enhance some non-financial assets, the organizations actually recognizes as a service, and they service revenue, and they record it as per the fair value. For example, any voluntary service donated by any labor by carpenters or electricians or masons. Now the second type of donations, that includes some sort of specialized skills, for example any legal or accounting service. So now we will see one example, and this example is from your textbook, page number 830. So assume that a CPA certified public accountant provides some accounting service to a local charity, and that would cost $20,000 if that person would not donate his voluntary service. Now assume that the one carpenter also donates their materials, which is $40,000, and also labor $55,000. So now how the not-for-profit entity could record those journal entries? So for the first item, they will of course recognize this expense, and they will call it general and administrative expense, and they can, to reflect the other side of their entry, they will use unrestricted categories of their net assets. And for the second category, since the carpenter is contributing some materials and labor, and that's actually for constructing some facilities that relates to some building and improvements, so you can record it as building and improvement, and you can also categorize under this unrestricted fund. One is a contributed service, another is contributed material. So this is how you're gonna record those contributed services. Now we will learn about tax-exempt status of a not-for-profit entity. This one is really very significant because because the primary reason for creating an entity as a not-for-profit is for these tax exemptions. And you will see there are three IRS codes, and that actually covers like all those types of not-for-profit entities. Section 501(c)(3), that is applicable to charitable, educational and scientific entities. Section 501(c) number 4, this applies to social welfare entities, and also those are sometimes referred to as advocacy group. And the last one, section 501(c)(6), that applies to business leagues, board of trade, chamber of commerce, etc. So here we can also remember some other items. These not-for-profit entities are always get exemptions from federal tax, but sometimes they may need to pay some state tax, especially for the third category. That means under section 501(c)(6), they may need to pay state tax. And donors always get reductions in their taxable incomes when they make those amounts, the amounts that as donations. And then there is another condition that the not-for-profit entities cannot engage in political campaign activity, but they can do some sort of lobbying, which is allowed, and they must need to file Form 990. Now we will see some concepts in the context of merger and acquisition. Merger and acquisition is really very popular and prevalent in the world of not-for-profit entities, and there are several reasons, and most of the reasons you will see those are kind of common. While like for-profit business in businesses engage in merger and acquisition, there are several reasons. First of all, they want to make like more efficient use of their resources. They may have some common goals, so if they work together, that may be helpful to achieve their common goal. Another is cost cutting. If they are merged or one company acquired another company, maybe they can reduce some sort of cost, and that will increase the efficiency. And also some charities, they can financially struggle, they can suffer or they can struggle financially, so another charity organizations can acquire the financially suffering charities, they can rescue them. And there are several reasons. Also another reason is to expand the scope of that organization. One company can be involved in any merger and acquisition, and there is one distinction. Acquisition, this term is applicable when you will see that one organization is actually acquiring and they are actually obtaining the control over another organization, and in that case we're going to use the term acquisition, and their acquired accounts are reported as per the fair value, and they also record goodwill in case of acquisition, and you have to check if the total amount of acquisition value is greater than the total value of those their identifiable assets and liabilities, and if they pay excess on top of their total value of their assets and liabilities, if the acquisition value is higher than that, then they will report as goodwill, just like some for-profit business. Now the entity that they are going to acquire, that could be supported by contribution, donation, or they could have some sort of like a specific fees and revenue. So if they see that those entities will be supported by contributions, then the excess value they can report as reduction in net assets as opposed to goodwill. Now the term merger, you're going to use this term when you will see that two not-for-profit entities, they are merged and they form a new company, and in that case they usually like none of them control each other, rather they create a new company, and in that case you have to use the carryover method. Now, in a merger, the newly formed not-for-profit records all accounts at their previous book values. So, if it is the case of merger, that means they are forming a new business and no one is controlling the other entities. A carryover method will be applied, and you have to record all those assets. You are just combining all those assets and liabilities as per the book values. The book values as of the date of their acquisition. Now we will see one example, and you will see several journal entries, and these are from your textbook, page number 834 and 836, and you will see some common journal entries when they receive cash or not. Every time all amount will be collectible, how they're gonna write off, and you will see how they record all those expense, asset purchase, and depreciation. So I will take you to our textbook to see the journal example. Okay, now I open my ebook and I am now page number, I think 834. If you have your textbook, you can see the examples. So here they gave one example. The example is about Shenandoah Seminary. It's a private college. They began their operation. Of course, it's a not-for-profit entity, and they have their unrestricted net assets, which is 12,500,000, and they have permanently restricted endowment. This is kind of their beginning equity type of thing, you can say. And then during this year, they received a number of contributions from alumni and friends. That's what we usually do. Any college, a private college like us, we usually try to raise funds. And then they have $130,000, which is kind of unrestricted pledge. There is no restrictions. It's kind of broad general category, and that is collectible in 12 months. And they receive another $50,000 cash contribution, but it is actually for restricted, and it should be considered against like endowment. That endowment means it's permanently restricted. So because any college or university, they cannot use those if it is defined as an endowment. So what should be the journal entry? It's very straightforward. Since they're receiving cash, $50,000, they will debit cash. Now they receive these contribution promise, and they will call it receivables because they will collect it in 12 months. So they will record contribution receivables, which is $130,000. Since they will collect it at the end of this year, you don't need to do the present value. But if it's if the collectible is for a long period, couple of years, few years, then you should record it as per the present value. Now here, what they're gonna do, here they have little more information. They say based on their past experience, they say that 85% of these unrestricted pledges would be received. That means 50% they may not be able to collect. Although they receive promises for all those $130,000 donation and contribution, they may not be able to collect 15% of it. That means 130,000 take 15%, which is 19,500. They will show it as allowance for uncollectible pledge. It's just like allowance for bad debt. You know, if you have any receivables for-profit corporations, and if you estimate the portion will not be collected, then we always transfer that portion for our ADA, or allowance for doubtful account. The same thing, we're going to transfer it to our allowance for uncollectible pledges. And then the net receivable amount, that means the remainder 85% of these contribution receivables, we will show it in our unrestricted net assets fund. Now this cash contribution was kind of conditional to increase the endowment permanently, so we have to show it in our permanently restricted net asset part. Now, before the end of the fiscal year, that college, actually seminary, collected 100,000 of this amount pledged, and they wrote off $5,000. So that means here the amount of collectible, they are able to collect 100,000. That means cash is collected, cash increase. So you're gonna debit cash, and since a portion of this contribution receivable collected, you need to credit or reduce this contribution receivables, but you also need to write off. That means a portion of these allowance for uncollectible pledges is now you are confirmed you will not be able to collect. So you will remove it from your allowance fund. That means you have to reduce your allowance, which we debit because it is usually a credit amount, and you need to take those amount out from your receivables too. That means you also need to reduce your receivables. So these 105,000 reflects 100,000 that you were collecting, and 5,000 you will not be able to collect. Now we'll see a few more examples. And it says that they actually received $20,000 cash gift from their outside donor, and there is one restriction. These amount can be used for a series of lecture by visiting scholars. And in addition, they charge 800,000 tuition and other fees to their students. And they are also giving some scholarships to their students, which is $200,000. So now how you will record it? First, they receive this cash gift. You have to debit cash, and since there is one restrictions that the cash will be used only for these guest lecture series purposes, so we'll show it in our temporarily restricted fund, and credit will be temporarily restricted net assets. Now here this tuition they charged to their students, so these you can call it tuition receivables, and it's kind of broad unrestricted category. If there is no restriction, either permanent or temporarily, or you can put in unrestricted category. So you're gonna credit unrestricted net assets. Now they are also giving some scholarships. So these scholarships they will debit as financial aid, and these portion they're gonna reduce from tuition. So their total tuition charge is 800,000, but they're giving a scholarship 200,000, so you need to take that out. So you have to credit or reduce your tuition receivables. Now they have some liabilities. Total is 640,000 and 575,000. Those are because of some expenses, and 65,000 because they purchased one equipment. And they also paid 625,000 of these liabilities. So these are straightforward. They have all these expenses, very different categories, very regular type of expense, instructional expense, student service, maintenance or administrative expense, and then they will credit all those as accounts payable, and they're gonna debit all those expenses. And then these $65,000 they purchase an equipment, so they will debit equipment, and then they will credit accounts payable. So if you add these two accounts payable, 575 and 65, it's total 640. Now out of that 640 they paid 625. So since they paid it, you have to remove that accounts payable. So you're gonna debit accounts payable and you're gonna credit cash. The last item is to record depreciation. If you have to record any depreciation, and these are on buildings and equipments, and if you know the lifetime, finite lifetime, then you have to record those. And these are pretty much straightforward, like for profit corporations, and they showed all those categories, all these depreciation expenses. They're gonna debit those depreciation expense, and they will credit accumulated depreciations. Now we will see one example, and this accounting method is specifically for healthcare organization. So this healthcare organization is a little bit different than other not-for-profit entities. One main example I can mention that the statement of functional expenses that all of these healthcare entities need to produce, which really make them distinct from other not-for-profit entities. And you know, healthcare expenditure is really huge in USA, and it is mentioned that few years back it was about like 17.6% of our gross domestic product, and most of the cases this amount is paid by third-party payers. So from a financial perspective, a private not-for-profit healthcare entity does not need to compute their net income figure, but since a huge amount of money involved, they need to produce a fair financial statements, and the readers really need to get some idea to measure the efficiency of their current operation. Although their goal is not to make profit, that doesn't mean that loss should be ignored. So FASB actually requires that they will produce this extra statement, which is called a statement of functional expense, to elaborate all of their expenses. And they need to prepare all those financial statements, and that could some sort of like provide a signal of their financial performance indicators, and that can also reflect their operational success or failure. So now this healthcare sector is also special because of another reason. In this healthcare sector, one major factor is that here, a lot of not-for-profit private healthcare institutions actually receive their payments from third-party payers. So who are the third-party payers? It could be an insurance company or Medicare, Medicaid. So these third-party payers, rather than the individuals, pay some or all of the cost of those medical services. And again, I'm repeating, a huge amount of monetary amounts are actually involved, so that those third parties, they really would like to know how reliable those healthcare entities' financial information is. And especially, they are really concerned about the source of the revenues and especially the cost of their patient care. So now we will see some examples, and examples those are from your page number 838 and 839. So I will show my ebook and we'll go over some examples, transaction examples, and some journal entries. Now let's see one example. It's from page number 838, and it's actually the journal entries for healthcare entity, and the example says that local not-for-profit medical clinic, their total patient charges is $750,000. Of this amount, only $170,000 is due from patients, because the remaining $580 that was billed to third-party payers, Medicare, Medicaid, or a number of insurance companies. Now, how they're gonna record it? So first, they will recognize their entire amount of revenue. So they will credit patient service revenue, the whole amount, $750, and then they're gonna split it up, because they have two types of account receivables. One, they are expecting to receive from those third-party payers, so they will categorize it account receivables, third-party payers, this $580,000, and account receivables patients, the rest, which is $170,000. Now we will see one example, and that example is related to uncollectibles, because it's really very common that sometimes some healthcare unit entity may not be able to collect all of those patient service revenues. Some portion might be doubtful. So what they do, they can estimate the portion that may or may not be collectible. That means it's some sort of like doubtful account. So they actually transfer it as allowance for uncollectible accounts, and they will also record this as bad debt. And then when they will get the confirmation that it is actually not possible to collect those, then they will show a contra revenue entry. So I'll show you another example, and that example is from page number 839. So this example, it says here that the clinic actually estimates that they will not be able to collect $20,000. So this is their estimation. That will be their patient receivables that will be uncollectible. And then they will again make it confirm that out of those, this $18,000 will never be collected, either because those patients have like very low income, they live below poverty level, or they could be bankrupt. There's no way to collect it. So now how are you going to record it? First, you will record this as a bad debt, and you are kind of considering it as an allowance. So you're going to record the provision for bad debt, debit 20,000, and then allowance for uncollectible amount, which is also 20,000. Now again, when they made it sure that $18,000 from their account receivable will never be collected, then they will kind of do the write-off. Then how did they actually do it? They actually do a contra revenue, account. So they will debit revenue account, which is really very unusual, but they will do it. So they will debit patient service revenues 18,000, and then again it's kind of a write-off, so they will subtract that amount or reduce that amount from their account receivables. So they're gonna credit account receivables. Now you will see that sometimes any healthcare entity may have some contract with those third-party payers, and that contract, it could be something that there will be some fixed rate that will be paid for a specific service, and it is really very common. So if they have this type of contract, and if they recognize some portions that they will not be able to collect, then they also need to show some adjustment to reflect that amount. So another example, it says here that that healthcare entity actually does not anticipate to collect these whole receivables, $580,000 from their third-party payers, and then they actually figured it out that they will receive only $420,000. That means these $160,000 will not be collected. So they need to do one adjustment. So the entry will be contractual adjustment debit, and then allowance for uncollectible and reduced amounts, it will be credit. So once they are kind of creating one provision because they are estimating, but since they have some contract with their third-party payers, so instead of using like bad debt, they call it contractual adjustment. So these are kind of some basic common journal entries that a healthcare entity can record. So you really need to practice those journal entries, and I'll also go over some sample exercise problems, although all problems are mostly conceptual, but I'll go over especially some number related to give you a little more explanation. Thank you for watching the video.